The stock market is crashing, and there are three major reasons why this is happening and why it could get even worse from here. We're calling this a silent crash because while most stocks have been bleeding for weeks, the S&P 500 is only down about 2.5% from its highs, thanks to just 5 big tech names holding it up. Under the surface, it's a completely different story. The first big problem? The US dollar. The massive rallies we've seen this year in stocks, crypto, and even gold were fueled by a collapsing dollar, which fell over 12.5% in the first half of 2025. But that trend just flipped. The dollar has rebounded nearly 4% in the past few weeks, and if it keeps rising, markets will have a much harder time climbing. Second, there's the interest rate story. For months, investors priced in aggressive rate cuts for 2025 and 2026, fueling optimism and pushing risk assets higher. But now, those expectations are fading fast. Fewer cuts mean tighter financial conditions, and that's never great news for markets running on liquidity. And finally, the most concerning chart, the yield curve. Specifically, the spread between the 10-year and 3-month Treasury yields. Every single time in the past 70 years that this spread flipped from negative back to positive, a recession followed shortly after. It's been accurate 100% of the time since the 1960s. That line just turned positive again, which means the clock may already be ticking for the next downturn.